Welcome to Dads and Dollars podcast with your host, Stanley Funches, certified financial planner, business owner, author, speaker, and father of three. Listen as Stanley shares his valuable insights around fatherhood and finances gained from over 20 plus years of experience. You'll hear stories, lessons learned, and the ups and downs he and his guests have encountered on their journeys as fathers, professionals, and business owners. These shared lessons will help provide you a path for financial independence while celebrating the challenges of being a dad. Thank you for joining the conversation. Here's your host, Stanley Funches.
All right, good day. Welcome to Dads and Dollars, the podcast where the perspective of fatherhood and finances are woven into everyday life topics. My name is Stanley Funches. I'm a certified financial planner by profession and a father of three in this thing called life. We're glad you can join us for season 1, episode 9. And on this episode, we have a guest, Damian Gilbert. Now, I've known Damian for nearly 20 years, and Damian is currently the vice president of mortgage products for Regions Bank here in the Southeast. Now, he's been a consistent go-to resource for myself, my clients, and many others in the area when it comes to mortgage lending. He's a father of 3 young men, with his middle son, Solomon, just leaving for college last week. So let's give Damian a great welcome to Dads and Dollars. Damian, welcome to it.
How you doing, Stanley?
Doing great, man. Thank you for joining the podcast, and thank you for joining the show.
Man, hey, look, I when I heard and saw that you were doing it, I demanded to be on. So I appreciate you. I'm honored, man, and man, you're the GOAT in this game, man. So I'm just honored to be with you.
Hey, man, I appreciate it. You know, we've known each other for a long time now. I said 20 years, and it's probably been 20 years. But what I want to do is, commend you on building a great career in the mortgage business. And, I appreciate the fact, and I know many others appreciate the fact that when it comes to when we have someone who's interested in a mortgage or they want a good unbiased opinion or unbiased thought on their current situation, me and other people send them to you because, that and you've been a great resource for people in the area looking for mortgages. So that's one of the reasons why we're glad to have you on the show and to talk more about it. So tell me, how did you get started in the mortgage? I mean, I've known you all this time, and I can't remember, how did you get started and say, hey, mortgages were the thing you're going to do? Because you've been doing it for a while now.
Yeah, man, it's funny, Stanley. I stumbled into it, right? A lot of times, some careers are you pre-planned, you're predestined. My son that just went off to college, he knows what he wants to do. I just knew I wanted to get in business in college. I didn't have a path of being in mortgage per se. But I will tell you what I did do is I just, and I tell anybody that's going through or matriculating through college, if they choose to do so, just be doing something, something that you're passionate about, that you're good at. And I was good at math, right? I was just always good at math. I was good at talking. I didn't know that those two would kind of intersect into this world. But the way I got started, to your question, was got out of college and I'm not going to say the year, but the late 90s.
In the 1900s.
1997. Got out and entered into a commercial training program at South Trust Bank here in the South, and again, originally from the West Coast. So didn't know much about South Trust, and but realized that it was a major player in the South. So I was honored right out of college to get into this program. So essentially what they did, Stanley, they put us on a rotation through the bank. They took us to retail banking, meaning, put us in the branch, kind of see what the branch is like. It was a 6-month rotation, if you will. Then they put me into like a commercial mortgage department, and just real high level, it's a department of the bank that lends money to mortgage companies, right? Okay. So I was this young guy, I was 22, 23, and I was flying around the country because we were extending these lines of credits to these mortgage companies so they can kind of do what they do. And again, I'm a trained person by nature to understand financials, balance sheets, income statements. So I had to basically not approve, but I had to review these financial statements of these owners of the mortgage companies that I'm lending money to, right? At that time, I came out of college, I was making in my opinion, good money. I was making to me, it was like $30,000. I was excited for that type of money. But I'm lending to these guys that are making $500,000, 200,000 back in the late 90s, right? 200,000 to $500,000. So I said, man, I started to inquire, like, what do these guys do? I'm approving loans or helping these guys get approved. And I was like, man, I got to get a piece of that pie, right? Not really knowing that's what I wanted to do, but once I started uncovering what these guys did, I understood one thing that was a little bit different, Stanley. They had a passion. They were making money off of a passion for helping people. Now, they were making good money, but these guys, when I started talking to them, what they did, and they started talking about, how they lend money, they start talking to realtors and contractors and whatnot, and they're lending money every month, 5 to 10 loans a month, and they're making this type of money, and their loan officers are making this type of money. I said, man, okay. I never owned a home, Stanley. Never owned. My mother didn't, I tell the story all the time when I'm out. I didn't grow up in a house that we owned a home. So I didn't understand home ownership. So these guys were teaching me around the country. It's simple. This is the process that you do. So man, I got into it that way. The commercial mortgage training program at South Trust Bank, did that for about 2 years, realized I was making a fraction of what I could make. And I was lending to these guys, but what I really found out after about a 2-year period was that my passion was helping people achieve homeownership, right?
Yeah.
I loved helping these guys, right? These guys, they didn't need me. They just need me to approve their $1 million line of credit. But my passion came with helping first-time home buyers, move-up buyers. I'm in my career now at the point, Stanley, you've seen it in your career, where I'm now helping the children of people I helped 20 years ago. I've seen these kids running around in my office, right? As kids, now they're buying homes. I'm helping them. So I'm passionate, super passionate about this industry. Historically, I'm a big history buff, Stanley. And that's a whole other piece that we could talk about at some other time. But historically, when it comes to finance, you know it as well as I do, we've been locked out. We were locked out for years. And to now be able to help people buy homes that look like me, that maybe to the point where they weren't able to buy years ago, I'm honored to do it, and it's super humble. So that's how I got in. I guess, I can go off into many different tangents.
No, that's great, man. When we all understand and when listeners can understand our origin story, right? How did this all come about, right? How is your passion, like, what is your real mission for the work that you do every day? And what we do know is that, from redlining to all other things that have gone on in the history of this country, there are a whole group of people who have not had access to home ownership, which is one of the foundational things for wealth creation, right? And so you being in that and having that as a passion and being a resource in that industry is fantastic. So you mentioned helping, the next generation. What can you tell people about mortgages, I guess, from a technical sense? Like, what are all these type of options that are out there for folks that they should be looking at, thinking about, especially now, rates have gone up from the 2 to 3%. They're going back to probably a more normalized 5 or 6%. So how could you educate them on, like, hey, here are some type of mortgages and products for different people?
Yeah, no, that's a question I get when I go out speaking all the time is, tell me what type of loan. What I always say, and I'll start it with this, Stanley, is that a mortgage is almost like a tailored suit, right? I like my suits, but every suit fits people differently. So first of all, you got to know your measurements. You got to know what you want. What type of do you plan on being in? And I tell this to people that are out in the audience looking, next few months to looking to buy. What do you want to pay per month? And how long do you plan on being there, right? The reason I ask that is, well, what you want to pay per month tells me, there's certain programs that's going to give you maybe a lower payment. There's certain programs or maybe shorter term loans that may be what they call, and I'll talk about this later, is an adjustable rate mortgage versus a fixed rate mortgage. So those are the things that I first want to find out. I want to kind of get kind of get the measurement of the client, figure out what they wanted, what they need, and then I start talking about that. So the fundamentals, there's a few things. There's a conventional loan, there's government loans, and there's what they call portfolio loans. Okay. And again, I don't want to get too far in the weeds. I'll keep it up here, but government loans or FHA loans, a lot of first-time home buyers will get that. It's 3.5% down. It's a low down payment. If you're a veteran, okay, there's a lot of veterans around here. Thank you for their service. It's no money down. Great product, low rates, no money down. And then USDA is what you hear are rural development loans, and those are basically outskirts of your suburban areas. You can qualify for no money down. Government loans, a lot of times because they're subsidized by the federal government or a federal agency, the rates are typically lower, right? Yeah. So they're typically lower. But there's some cons to that I can talk about in a second. But conventional loans, which is that second tranche, you got government loans, you have conventional loans. Conventional loans are essentially backed by Wall Street. That's the easiest way to say it. So those are, you'll see people putting 5% down, 20% down. And then you have your portfolio loans. And that's what I like to talk about the most, because most lenders that you go to, whether it's a mortgage broker or a mortgage banker, I work for a bank, or a mortgage broker, which is a broker that will go out and look at different banks, and they kind of figure out what the best option is for you a lot of times. As a mortgage bank, we have what they call a portfolio. So again, tranche, government, conventional loans, and portfolio. Several banks, when you're talking, you want to find out, if you have specialty programs that may be able to give you a little bit better cut suit, right? Portfolio products give us that opportunity for first-time home buyers to do some special things. If you're an emerging professional, an attorney, engineer, if you're a doctor, we have a few other bells and whistles that we can kind of play with in our portfolio. So what I always tell people, Stanley, if you're a first-time home buyer, move-up buyer, inquire with your bank. What options do you have in your government space, in your conventional space, in your portfolio space? And a good lender is not going to be, again, I can talk about 1,000 programs, but those are the three main categories that everything waterfalls under. And then when you go to your lender, what do I want to pay per month? How long do I want to be there? Those two things, if you're armed with that as a first-time home buyer or move-up buyer, or buying again for the fifth or sixth time, that matters. Or if you're looking to refinance, you need to know these things. So I always say be armed with those 2 or 3 questions, and then a good lender will be able to kind of tailor fit a product for you.
Oh, that's awesome, man. So you mentioned in the course of explaining those 3 different type of major loan types, you mentioned mortgage banker, mortgage broker, and
yeah.
Even from my experiences, like, what would you say would be the differences and the advantages and pros and cons of each? When people are sitting and they're trying to think, okay, should I go to my bank and look for, or should I go to this mortgage broker? Because I'm sure that there's cons in either side, and there's pros, so it's different for different people.
Yeah, and that's always the $1 million debate, right? Is it a broker? Should I go to a broker or a banker? A broker, again, is an individual that's not tied to any particular bank, right? They have agreements with several different companies throughout the country, and they may be able to pull down something for you that makes sense. Again, they may be able to find something tailored to you. The one thing about brokers, and I've got a lot of great friends that are brokers, they're a lot of times they're a little bit more nimble. Something that a traditional bank may look at as too risky, a broker may have 10 different companies that they work with. 8 of the companies feel like it's risky, but there's 2 that say, no, that's not risky. We'll do that. So if you have a kind of an ordinary circumstance, maybe you're self-employed, maybe you just need to show bank statements as a self-employed borrower. A lot of times brokers have those products that banks don't. traditionally do that type of stuff. As a bank, a lot of times if you bank with the bank that you do a mortgage with, it is super easy because we can pull all your information. If you don't, banks again have portfolio products. That's why I land there. Just like I was saying a little bit earlier, we have special tailored products for certain people, first-time home buyer, 100% financing with no mortgage insurance, special ARM products, adjustable rate mortgage products, special doctor programs, so we have different programs that brokers just don't have.
Mm-hmm.
A lot of times the banks that they get their or procure their business from, they may have 100% product, but they're not going to offer to that broker. That person will need to come to the bank to get that specialty product. But again, there is brokers that do a great job out there. So not here to debate my good broker friends. I'm a mortgage banker by trade. So again, I lean to one side here. But I think, again, the bottom line, Stanley, you got to go with somebody that you trust, that you're comfortable with. Because a lot of times, other than the portfolio products that I was talking about that the banks have, we all pretty much can do the same thing, right? It's who can tailor you the best? Who do you feel most comfortable with? And who can kind of share that vision and story of what you and your family want if you're looking to purchase and understand your financial goals.
Yeah. So I think that's great insight. You really, from what I'm hearing from you, is you really need to understand your situation as someone who's looking to purchase a home, not just to go and say, hey, I just need to go find a mortgage, but understand what you want internally, goals, objectives, where you are from a financial standpoint, and can you qualify for any of these special programs that may make the decision for you? If we have a lot of physician people in the medical profession as clients, and I know for a fact that those loans and opportunities they have are tremendous at the bank. If they can get in and get qualified for them, it's like a no-brainer. So I hear what you're saying there. So when you have people who are first-time buyers or trying to move up, what do you try to work with them and try to tell them? Like, say some people may not feel prepared right now to buy a home. What would be some tips you would give some of our listeners about, okay, hey, take care of these few core things to get yourself prepared to purchase a home or purchase your next home?
Yeah, just one fundamental thing is really just make sure that you understand your debt situation, right? One major thing that I always talk to people about is understand your student loan situation. A lot of my clients have student loans. They went to college and they have student loans. Just understand your debt situation. Where's your credit card situation? Pull your own credit first, or you can go to a lender. If you're not ready and you say, hey, look, I'm ready in a year now, talk to a lender, get your credit pulled, take a look at it, figure out, are you ready at that point? The fundamental thing is understanding the debt and understand, is your income stable? I have some clients that they just started a business. They've been in business for a year. Are you really stable enough? And are you ready to enter into a major purchase like that? Some people want it for status. They want to buy a house for status. No, it's a financial goal and it's a means to financial wealth in the future. So I always try to say, make sure that you're stable from an income standpoint. Look at what your debt load is. And are you paying your bills, right? Yeah. In the last 12 months, be honest with yourself, right? Are you paying your bills, right? Yeah. I don't pull. I remember, years ago and, where it used to kind of be kind of funny, man, I got bad credit. That's not funny. That's not funny. No. Because at the end of the day, right, if your credit, and everybody goes through situations. I always tell people that people have had credit situations, but it's not a laughing matter if you got bad credit, because you will know that a lot of times it's tough to either get a loan or you're paying thousands and thousands of dollars more of interest. So I always say, understand what your credit situation is. Again, debt situation is different from credit. So you may have great credit, but you got a lot of debt. So one of the things that I always tell you, Stanley, and I tell my cousins, I tell my mama this as well. You don't need a JCPenney's card. You don't need a Macy's card. You don't need a Belk. You don't need 10 department store cards. I know you're getting that 10 to 15% off, right, Mom? But consolidate some of those credit cards before you go and make a major purchase, whether it's a car or whatever, because we look at your income to debt. If you have 10 credit cards and you're paying $20 here on $200 balances, that's $200 a month, right?
Yeah.
Well, if you had two cards with, let's say, $1,000 balance, you may be paying $20. And maybe the minimum balance is $20. Your debt to income ratio is better if you have two cards, because you can get the same thing with your Capital One or your Delta, American Express, whatever that credit card is, than just getting a higher interest rate credit card at the department store. Sometimes it makes sense. I'm not saying not ever do that, but you don't need 10 credit cards. Consolidate those credit cards down to 2 or 3. That's the biggest advice I give to my young folks. I tell my sons this. I tell them, look, when you go off to college, when you're out, one of my sons didn't go to college, but he's out. He only has one credit card.
Yeah.
Keeps him nimble. He can make decisions. He's not stressed. So that's one of the biggest pieces of advice that I always say, man, if you want to be prepared for home ownership, make sure that your debt's low, you got stable employment or stable income if you're self-employed, or if you're not self-employed, do you get stable retirement income or Social Security income? And the other thing is just making sure that you pay your bills.
So that credit score is a big part of the gateway to entry into wealth creation with using leverage, which is using mortgages or other lending products to build businesses or whatever. And so in episode 5, if for everybody who's listening, if you go back and check episode 5, we had a guest and he went over how to help improve that credit score to help in preparation for home purchases. So when people how do they know? Let's say I come to you and my credit score is good, my debt situation is light, I'm cash flowing well. What do you talk to them about as far as affordability for a house? If we think about 10, 12 years ago, when people were handing out mortgages and people got overextended and bought more home than they could afford, we know the bank and brokerage companies don't do that same type of lending anymore. But how do you help people not overextend?
Man, I know you've been in the game a long time, so that's a great question for somebody that has seen this for a long time.
Yeah.
One of the funny things that we do in the mortgage industry is that, Stanley, we will approve you based on your gross income. Again, I'll say that again. We approve you. We determine your qualifications based on what your gross income is. Okay. I don't know anybody personally that gets paid on their gross income. They get paid gross minus their 401k, their taxes. Everybody gets theirs, and then your mortgage payment, right? Or then your actual pay that you take home. The one thing that I will tell people is, what are you paying in rent right now? A lot of times people will come to me and they're paying rent currently. Let's say in this market, I'm seeing people paying rent of $1,500 a month.
Right.
Well, do you feel comfortable around that, or do you feel comfortable? What's your budget above that? My point is, I always say, what do you want to pay? What does your budget say that you qualify for? I brought up the fact that we qualify you on gross income, Stanley, is because a lot of times we qualify you for a lot more than what you should be able to qualify for. So you want to make sure that at the end of the day, when you walk in and talk to me, or talk to anybody on my staff, what do you want to pay? So that's the one thing that I pound that. People will come and say, hey man, what do I qualify for, Damian? Well, I don't know. What do you want to pay?
Yeah.
No. You tell me. No. You tell me what you want to pay first, and then we build around that, because the mind is a funny thing, Stanley. If you come to me and I tell you that you can qualify for a $3,000 a month payment because you have no debt, you have one credit card, again, super stable income, credit's good, and I say you qualify for $3,000 a month, guess what you're going to do? Man, hey, I don't need to get that hair appointment. I don't need to go shopping. You start figuring out, your mind is kind of malleable. You start trying to fit in what I can get that. But what I turn around and what I found is, if I tell you what you want to pay, I want to only pay $1,900 a month. And then I do the calculation. Oh, man, they qualify for $3,000. Hey, here, based on what you tell me, you want to be at $1,900 a month or again, $1,000 a month, whatever that number is, this is what you qualify for. You comfortable with this? No, that's it, man. I'm looking at, I can't find anything. Well, let me tell you, you qualify for this, but you already told me that you want to be at this, you want to be $1,000 less in payment. We got to really make sure. So that's kind of a level set for people that I try to make sure of, and any good lender will do. Because of course, banks get paid off of how much they lend. But at the end of the day, I've been doing this long enough, Stanley, that I've seen this on 5, 6 years down the line when people are struggling.
Right.
So again, I always tell people, you pay what you're comfortable paying, get your mindset around that, and then you go out and find something from there. If you feel like you got to go up, but you really got to convince me, you told me you wanted to be at $1,500, but now you're comfortable at $3,000. You got to really convince me how and why that makes sense. Again, I work for the customer, but at the same time, this is what I do. I've got to sleep at night making sure that I'm putting you in the best financial situation possible.
Man, I think that's such a great way to frame it, because a lot of people, I mean, we try to frame it that way as financial planners, right? The exact way that you're saying is, let's figure out what you can afford based on the standard of living for now and what we want to do in the future. But a lot of people don't work with financial planners, or they can't afford it. They don't feel like they're in a position for a financial planner. But I think the way you just framed it, which means that, okay, hey, if you're spending X on living costs now, and if you can ramp it up a little bit, then fine. Figure out what that number is, and then we can back into what house purchase that looks like. And if more people took that route, then they wouldn't get overextended when the calamity happens or the market, and they get, unemployment, they lose their job, or their business is not producing the same amount. If they can figure that out, they don't go and get, that $800,000 to $1 million house when they really probably could only afford the $300,000 to $400,000 house. Right. Even though the bank will lend them the money because they put themselves in great position.
Mm-hmm. Right. Yeah, that's exactly right.
I think that's a great lesson. So, like, let's say, for instance,
I heard the little plug for the financial advisors, by the way. I heard that. I swear by a financial advisor, first of all. But anyway, go ahead. Sorry, Sam.
Yeah. Look, we're going to probably have a podcast on that because people want to understand that a little bit better too. Right. But one of the things I was going to ask you is, like, okay, so people are sitting down at the table and they're ready to get mortgages. So one of the things that we ask them to do is to send that information into us prior to them sitting down in the closing so they can kind of compare. But there are some things that I think from that people should look out for, whether they go to a mortgage broker or mortgage banker, to make sure that their interest is being taken care of. What are some of those things on those loan estimates? It used to be the good faith estimate, right? A long time ago. That's changed. Yeah. What are some of those things when they get those loan estimates that they should be looking out for that people really don't have a clue? They just look for the payment. But what are those other things that maybe they can negotiate? Maybe they could, maybe excessive in some cases. Kind of share that information with people.
Yeah, no, that's good. So I'll give you an example. So let's say you're comparing X bank, mortgage broker versus your mortgage banker, or mortgage banker versus your mortgage broker, X company versus Y company. Every company has to, by law, provide a loan estimate. Okay, so very perceptive by you, Stanley, because at the end of the day, this bank said they can give me a 3.99% rate today. Well, rates right now are between, high 4s, low 5s, depending on the product that you're at. This bank said that they can give me 3.99. Well, that's great. Okay, show me the loan estimate, was what Stanley would say, right? So loan estimate A from one company is by golly, it says 3.99. Loan estimate from company B says 4.875 or 5%. You initially say, man, I love this 3.99, okay? But the reality is, a lot of times what they're doing is you got to go back to the origination charges. Discount points is what they call it. In layman's terms is, again, as a good friend will say, as the goats can get it, is you hear a discount point, it's to buy your rate down. So that 3.99, they may be paying $5,000 to $6,000 just to buy that rate down from that 4.875 from company B. Company A says, I'll get you at 4%, 3.0, I'll say 4%, just to keep it simple. 4% versus 4.875. What Stanley will and I will look at, and any other good lender is going to look at is, so you're paying $6,000. What's the difference in payment between that 4% and the 4.875? Well, Damian Stanley, it's only, when I look at it, the difference is only $60 per month. Okay, how long do you plan on being there? I only plan on being there for 4 years. It doesn't make sense to pay that, because you will never recoup that $5,000 to $6,000, right? Those are simple calculations. So I always tell people, rate is important, but what you're really comparing, and I can go into this, as APR or the points, the origination charges, because everything else on the loan estimate, Stanley, the attorney fees, and again, I don't want to bore the audience with all these limited fees, but attorney fees, title fees, all these things are going to be pretty much the same. Insurance, if you go with one insurance company and you put in your mortgage company, give it to your mortgage company, give it to another mortgage company, it's going to be the same insurance, same property taxes, same attorney fees, all that's the same. What you're looking at is rate, and is the lender got specific lender fees, origination charges, discount charges. That's what you want to look at. And it's the first few fees on that loan estimate. A lot of people just blush over it. Some people are fine paying that, and they just want the low rate. That's okay. That's okay. Yeah. But the thing that you have to say, if you're looking at two different lenders, hey, this lender got me at 4%. I'm paying $6,000. Well, if you did 4,000 or 4%, what's your cost? Oh, it's only gonna be 3,000. Oh, okay. Then I'm gonna go back to company B because they can give me 4%. I just didn't ask them what it's gonna cost. So some companies start a little bit high, some start with the lowest, and they'll charge you the highest. So again, circling back to your initial question, the main thing is origination charges and loan discounts, for which you want to look at on the loan estimate. Everything else should mirror the same for each company on that loan estimate.
Yeah. I mean, yeah, that's a great point out when it comes to rates and the total cost of borrowing, right? I mean, there's a total cost of borrowing that's there, and also knowing, again, we're going back to the purchaser knowing what they want in their situation, right? If I'm going to be here for 10 years or 30, oh no, this is my forever home. Oh no, this is just my transit home. I'm going to be here for 3 to 5 years. I'm going to go to another. Whatever your personal situation kind of dictates that rate and cost, that initial cost structure to get that loan. So again, understanding your goals and objectives when you're sitting at the table with what I'm hearing you say kind of helps you determine whether those costs are even something that you should incur or not.
Right.
So good stuff. Good stuff. All right. So a couple other questions here about just mortgages in general. And I was wondering this, the PMI world has changed, right? Can you kind of, for people who may have purchased a home 10 or 15 years ago, now they're looking at a home now, can you explain the differences in maybe products or thoughts when it comes to private mortgage insurance? And explain private mortgage insurance too for the listener.
Yeah, no, private mortgage insurance, and again, I don't care how educated you are or whatever, not educated, whatever it is, I have to remind people, mortgage insurance isn't for you. It's for the bank. In the event that you default, it ensures our position as we insure your loan, right? So years ago, like I'm, 50 years, been in this game 50 years, but 10, 15 years ago, their private mortgage insurance on FHA, and I'll have to go to the government loans, FHA, a lot of first-time home buyers will get FHA loans. And in your mortgage, you have a principal and interest, property taxes per month, homeowners insurance per month, and you have private mortgage insurance per month. Okay, that makes up your mortgage payment typically. Private mortgage insurance on, let's just say a $200,000 loan may be upwards of $150 per month. On a $500,000 loan can be $300 a month, right? So a lot of people are trying to get around that. So if you've been in a loan for 10 plus years, typically that falls off, okay? So let me go back to the FHA or the government tranche, conventional tranche, and portfolio tranche. Your FHA loans, that now stays on there for good. Okay, it goes away. Years ago, that would fall off after a certain period of time. Conventional loans, as long as you get to 20% equity, meaning if you bought a house, you know, you had now that the value of that house has gone up, or you paid the loan down and now you have 20% equity, meaning the difference between the value and what you owe, there is no, that PMI drops off. It can drop off as soon as a year, 2 years. Typically that'll drop off anyway in 10 years. Again, remember FHA, it doesn't never falls off. Conventional, it will eventually fall off if you've been there 10 years. Okay. So I always say, if you know that you're in a rapidly rising price value environment, you want to go to your lender and say, hey, can I check to see if my value versus what I owe is at least 20%? There's some people, I guarantee you right now, that are in PMI, that have PMI on their loan, that can call their lender right now and say, hey, can you evaluate my loan to see if my value versus what I owe is there? If you don't want to do that, I always tell people, go to Zillow, go to realtor.com, look at the houses in your neighborhood. What are they selling for? Are they selling 20% more than what you owe? Get that PMI off, because that's instant savings right there, right?
Yeah.
And then your last one is your portfolio loans. A lot of those specialty programs that the bank has that I've been talking about typically don't have private mortgage insurance. So that's an instant savings. So again, going back to your example of the loan estimate, a lot of times you may have a portfolio loan that starts out at 4.875 versus somebody's getting a 4% rate. But if they're paying an extra $200 per month in their loan on that, again, insurance, taxes, and PMI at 4%, but you've got a rate at 4.875 where you have property taxes, homeowners insurance, and no PMI,
yeah,
you may be better off at the little bit higher rate at a portfolio loan than doing a 4% with no PMI. Again, it depends, right? It depends on how long you're going to be there. So we do that analysis, because we could do that 4% and do PMI, because if you stay there for 30 years, it may make more sense. You may save more in interest on the long run. It's a whole analysis that you want to make sure that we look at when you're talking to your lender. So that's PMI, private mortgage insurance. That insurance does not help you. It does help us in the event that you foreclose, but FHA programs. And the one thing, let me go back to that real quickly, Stanley. I just want to make one point. FHA loans are a lot more liberal in terms of credit score requirements, right? So you can be as low as 580, whatever that is. Most conventional or portfolio loans, you have to be 620, 640 and above. FHA, you don't have to be as high. Okay, so that's why that private mortgage insurance is on there for good, right? So
yeah. So look, so for the listeners of Dads and Dollars, you just heard something for many of you guys that is savings. You can go with the way real estate has appreciated. If you have private mortgage insurance on your loan, you need to figure out what the value of your home and how that increase is impacted over the last 2 or 3 years, so you can go and try to get that off your loan. We just, so for some people that may have saved them money. And also, to prepare yourself not to have private mortgage insurance is to make sure that you have your cash position in a point. If this is your first home or you're getting equity from your previous purchase, to make sure you have enough to bring 20% down to the table. That way you can go a route where you don't have private mortgage insurance at all. Am I correct in saying that?
That's absolutely right. That's absolutely right.
So if you're planning ahead of time, try to make sure that you can come to the table with 20% down, so you have ultimate flexibility. And now, one other area I wanted to make sure that we talked about was rental property, investment property. You got a lot of people out there who are looking for ways to get passive income, to build a real estate portfolio. And I know you've had real estate in the past, and you have real estate that you worked with. What would be some of the loan products that are out there, or the advice you would give people how to use leverage when they're doing rental property or when they're flipping property? Just give them a little insight around that.
Yeah, I've worked with several folks that, they have some rental properties that they may have, let's say, I'll just use an example of 2 rental properties out there. Okay. Or let's start, you have no rental property. Say you want to get into this. So I'll start from that. I get a lot of people that will, because of the instant rise in values of the home that they're in now, say, you know what? I'm looking at, I want to tap into the equity to purchase another property. So I'll use just a quick example. Somebody owes 200,000. They find out now their value is, I'll use 300,000. I'll use 400,000. So they have 200,000 in equity that they're able to pull out. They use leverage, to your point, and they'll pull out some cash. They'll get a home equity line of credit or home equity loan, meaning that they go back to the bank and say, hey, I've got $200,000 in equity. My house only owe 200,000. I'm valued at 400,000. I want to get a little bit of that equity. I want to pull about 70, 80 to $100,000 out. They pull that money out and they use that to go buy another property, rental property. They put 20% down on one. So if you find a property for, let's say 150,000, you want to put 20% down. What is that? That's $30,000, right?
Yeah.
They use that. They use some of the cash to fix it up, and they start renting that property. There's instant cash flow. Remember what I said? They pull out 100,000.
Right.
They only put 30,000. They use maybe about 20. Now they still got 50,000 from that home equity line of credit. Now, if they start cash flowing on that property immediately, I've seen them use that same line of credit, go buy a second property, okay, or a third property now, right? So you got your primary, your rental property. Now they get a second rental property using that same home equity line of credit, and they put it into that property. Okay, they buy another one, put 20% down. But you have to put 20% down on an investment property. If you don't want to tap into it, some people are very conservative. I don't want to tie up my rental. I don't want to have my rental property tied up with any equity in my primary home, because if anything goes wrong, I don't want it. So I get that. Some people can go out and you just you find a property that you want to buy for 150,000 or 100,000. You just need to be prepared for 20% down. The problem right now is, where am I going to get the money to fix it up if I have to, right? So you got to determine, are you one that's willing to buy a property that you need to fix up? Because if you go to the bank, a lot of times you can't get a loan for a fixer-upper on an investment property.
Okay.
So another show on maybe hard money. How do you, as an investor, go and get money to not only to procure the property, secure it, and then get money to repair it? That's a really expensive proposition, but a lot of people use that as a way to do it. Again, hard money is basically not a mortgage broker, not a mortgage bank. It's, a lender out there that's willing to do some more risky type of financing for investors. Again, you can bring me on the show and we can talk about that at some other time. I don't want to get people confused, but using leverage to, whether it's your own home, banks will also lend on investment properties as long as they're in livable condition. So I get a lot of people buying investment property, putting 20% down, renting it out, buying another one, renting it out, using banks' money. So when you say leverage, I may have $100,000 of equity in my home, but I don't want to use all that money. I want to use the bank's money to go ahead and purchase another home, get that cash flowing, getting comfortable. Stanley, I promise you, if you work on him, he's not going to let you get out there. He's going to make sure you cash flow before you start getting way out there. You buy another property, you start cash flowing on that. So you start building that portfolio of real estate where at some point that rental property and that cash flow will be handling everything that all your bills at that point. So great point. We do lend. I think that's where you're trying to get to, is that most banks, most brokers will lend to investors that want to leverage or get a loan to buy an investment property. Again, the key is the property either in livable condition or not? If it's not, then we got to start talking a different type of route to get that type of.
Yeah. And so if it's not in livable condition, you're trying to get a fixer upper. Again, this is where your personal net worth and your personal financial planning, so do you have the cash, the investable dollars to invest in the property as if you were going to invest in the market or whatever? So to make sure that your personal financial situation is such so that you have the flexibility when you go to the bank, that you have enough cash or marketable securities enough to say, okay, hey, I'm going to be able to fix this up on my own. I can put the 20% down plus the 15, 20 grand to fix it up. Can Mr. or Mrs. Bank, can you give me the rest?
Right. That's right.
Yeah.
That's right.
Yeah.
Yep.
So, man, you mentioned your kids later. So tell me a little bit about, this is Dads and Dollars. So we always talk about fatherhood here. So tell us about your sons. You got 3 sons. So tell us about them.
Man, look, I am a proud father, man. This is what I do. I feel like I was blessed to be a lender and lend to my community. But I feel like I was put here for these three young men. Nehemiah, who's 16, Solomon, Nehemiah still in high school, Solomon, who we just dropped off at Arizona State University. He is a Sun Devil. A little concerned right now. This is his first week about partying and all that good stuff. So the normal stuff that you're concerned about. If anybody understands Life 360, I'm on Life 360 all the time, checking to see where my son's at. It's funny. I'll tell you this real quick. I'll step back. Solomon is what I call one of my most independent children. If they're listening, the others will debate that. But Solomon probably the most independent, Stanley. But I'm looking at Life 360. Anybody understands that you can kind of track, you put a tracker on their phone, you kind of see wherever they're at, because the kids don't leave their phones anywhere, right? So I think it's ingenious. So essentially, we dropped him off on Thursday in Tempe, Arizona, last Thursday, Stanley. I look on Life 360, I'm like, is he really in LA? Is he really in LA? We drop him off. We leave him for 2 days, and he's already in a whole other state. So, okay, I digress. But Solomon is a business major. We're doing a minor in film production. So he's an actor, hence why he's running to LA back and forth, and why he wanted to be closer to the West Coast, where I'm from. And then Demarius, my oldest, it's really cool. My oldest is 27 now. All three of us went off to the lake before Solomon went off to college. So it was just kind of a guy's weekend. It was Nehemiah, Solomon, and Demarius. And it is one of those surreal moments when you're sitting across from your three sons, you're looking out, just beautiful, music's playing, and your 27-year-old says, "Dad, what, you want to have a beer with me?" At that moment, I almost shed a tear, man. It's just moments, right? It's just moments that you're just like, man, I'm really like these three whole humans' father, right? I'm blessed to be sitting here, healthy. And why that matters so much to me, Stanley, and we don't talk about this a lot, but my dad passed when I was in college, when I was 22 years, when I was going into my junior year. So I didn't get the opportunity to have that moment. Dad, let's have a beer, right? I didn't have that moment, right? And to have two sons, Solomon, who's 18, who probably would ask me to have a beer, but he's probably too scared to ask me, right? But to have sons that are willing, that I can sit, that I've raised, that I'm raising, along with their amazing mother, to be able to look at them and for them to be successful young men. Again, Demarius didn't go off to college, but he's a great young man. Great young man. He's doing the right things. He's respectful. Nehemiah, my youngest, respectful, just great young men. And again, I give that to the community, the village, and a lot of headaches for me as well. You know how it is.
Look, your story about the so my daughter is she's 22, and so the last trip was, oh gosh, I can't remember. Was it the last trip? I think it was the last trip to Chicago. Or she was like, "Dad, when are you gonna have a drink with me?" I'm like, no, like this is not something that dads do. Like for me, I grew up, alcohol was always a bad thing. It was never a good thing.
Right.
I just perceived it to be that way. It was always a bad thing. And so emotionally, that moment when I said, okay, you can get a glass of Prosecco, was probably one of the most conflicted emotional moments that I've ever had in my life.
Right.
Just because it was, it just felt like, it felt taboo for me. Which, I know, hey, look, I mean, I was 21, 20, I mean, I went to school in New Orleans. So, I mean, I don't need to say anything else, right?
Right.
But at the same time, I think that was a pivotal moment. So when you mentioned that, I thought about my own experiences there. And it's good to have, I had another episode on here where I talked about kids being grown. And, coming to that realization that your kids are older and more independent and grown, and you can drop them off in Tempe and they can find themselves in LA and you just don't even know. Now you got
That's right. That's right.
See, me on the other end, ignorance is bliss for me. I don't want to know. Just make sure you're okay. I don't want to know. So ignorance is bliss for me. Like what they're doing, like I raised you as best as I could. Make good decisions. Treat people well. I don't want to know.
That's right. I'm about to pause it on him because I'm going crazy. I'm waking up at 2 or 3 o'clock in the morning, looking at this guy's still driving down. I'm like, oh, God, But again, like you said,
look, man,
I gotta get with it.
When we were younger, I mean, we didn't have the technology. Parents dropped us off, and look, we figured it out. I mean, we figured it out. And,
that's right.
and even though the world is more complicated today, and at least in my view it is, they'll figure it out too. And we just pray for them. Right? My dad told me, he said, look, I thought I knew how to pray. But when you went off to school and my kids left the house, he said, that's when I really, really knew that I needed to pray. He said, God, I just pray for you guys. All the time. And I said, well, I can definitely tell in my life that he did pray, because there were a couple of situations that now I look back on it, I'm like, yeah, that prayer was needed.
Yes. Yeah, that's real talk, man. That is real talk, man. I do a lot of praying, I promise you.
Yeah.
My 27-year-old helped me when he went off. So Solomon's got a little bit softer blow. Nehemiah, my youngest, man, we're getting him dragging and screaming, man. He is my smartest, but man, he is the most bullheaded. So I can imagine him being out the country as soon as we drop him off in college. So, but anyway, man, that's why it's so important to me, is that my dad didn't have those moments. So somebody asked me the other day, Stanley, what advice would you have for, as a dad, being a career-minded, doing my thing, providing for them. Moments matter, and what I mean by that is I found myself when I dropped him off and I just did a lot of reflection. There's pictures that I went back to look at, I don't even remember those moments, right? Because I was working my butt off. I was just grinding. I was getting to the top of the food chain, just trying to make sure I'm providing. But stop. As a dad, man, it is a blessing. It is a blessing from God, man, to be able to raise children. So what I do now, and one of the things that I started doing later after my oldest went off or left the house, is even when I'm in my car and my sons are in the car and I'm driving with them and my phone rings, are you okay with me answering this phone? Are you guys okay with me answering this phone? Even when they were little, I would start saying that several times. And I didn't stick to that. And I tell people, whether you are early on in your fatherhood journey or later on, just when that phone rings or when your child is trying to get your attention, remember, you'll never get that moment back again. And when they're gone, they're gone. They're gone. They're gone. Some come back, but most part, they're not coming back. They're not going to come back the way you want them to come back, where you can hug them and coddle them. They're coming back as real men, right? With real issues. So
the kid is gone. So
the kid is gone.
So that, I think that's a great nugget to kind of end on. Like, hey, look, the moments matter, right? As a dad. So whether you have young children or you have adult children, you get to spend time with them. Embrace that moment and realize that they need you in that moment and you need them in that moment. So, hey, Damian, thank you so much for joining us on Dads and Dollars, man. It was great information. We hope all the listeners, got something from it. And so thank you guys for joining us on Dads and Dollars for this episode. Again, as always, please rate us, review us, give us 5 stars if you got anything out of this podcast that was beneficial to you. So please give us 5 stars, and we will see you next time on the next episode of Dads and Dollars.
thank you for joining us for this episode of Dads and Dollars. If you found the information shared today valuable, please share with your friends and family via your social media. If you have a request for a future financial topic for Dads and Dollars, please email us at ask@dadsanddollars.com. For further information on your financial journey, you may purchase the Quest for Financial Independence, 10 areas of your financial planning you should not ignore, by visiting our website, dadsanddollars.com. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Individual tax and legal matters should be discussed with your tax or legal professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.
Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to make a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. Asset allocation does not ensure a profit or protect against a loss.
There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of these strategies. Investing involves risk, including possible loss of principal. Guests and their companies are not affiliated with or endorsed by LPL Financial or Intellis Advisory Group. Securities offered through LPL Financial, member FINRA, SIPC. Advisory services offered through Intellis Advisory Group, a registered investment advisor. Intellis Advisory Group and Intellis Wealth Management are separate entities from LPL Financial.